got a jam-packed agenda. Let's dig right in to this cash flow webinar. You're going to hear from me. You're going to hear from Crystal Schultz talking about utility sales tax exemption. Jem Donovan's going to close us out talking about ERC and R&D and some energy credits. And Mark Griswold's going to be in the middle there talking about IC Disc. Here's what we're going to get through in 60 minutes. I'll do the climate economy and the energy incentive program. Crystal will go. Other Mark will go. Jim will then do the production, research, and employee retention credit, and we'll be on our way. All right, the climate economy. At the passage of the Inflation Reduction Act, the CBO estimated $374 billion to be given in energy incentives. A lot of these incentives, many of these incentives were uncapped. So really it can go higher. And that's why you'll see there that Credit Suisse came out with a report and said, we think it's going to get up to $800 billion of goodies handed out in the next 10 years. So really, where the final number lands will be up to us and how much we utilize these incentives. The government very rarely, never, will force you to take an incentive. You must be proactive. So let's see if we can get closer to that 800 billion. All right, courtesy of the Inflation Reduction Act, energy incentives are enhanced and they're available for 10 years. So imagine what you can do with 10 years of certainty and materiality. So if you're in the accounting or the tax department, you can proactively plan for these incentives in your capitalization policy or your fixed asset ledgers. Furthermore, you can contribute and achieve cash flow through tax savings and your company's ESG efforts. And if you're a developer, owner, contractor, architect, you can now proactively plan for these incentives on your capital requests during design and construction. And you can design and build sustainably, while at the same time decreasing your tax liability. So there are roughly 24 new and improved energy tax provisions in recent legislation. We are finding with our clients that these three right here are the most popular in the built environment if you're building, renovating, or designing something. So let's go through them. The first one is the energy building deduction. You're doing energy efficient lighting, envelope, or HVAC, you may qualify. It's now up to $5 a square foot, starting in 23. That's the one that falls under the tax code section 179D. In the middle, the clean energy investment credit. So you invest in energy property, you can get 30, maybe 40%, maybe even 50%. We'll get into that a little later, of the basis of that energy property back as a credit. And a bonus, if you're an exempt organization, think healthcare, you get a check in the mail, you get direct pay. And that falls under section 48. And then the last one is a residential one. That's for energy efficiency and residential construction, and in the scope of this call or this webinar, senior housing and healthcare. It's really about $2,500 per unit, but if you're going net zero gold, it can get as high as $5,000. And the code section there is 45L. One thing to note here, you may be wondering about the 6 and 30%, the difference. Congress is incentivizing you to pay prevailing wage. So for a lot of these bonus amounts, these higher amounts, paying prevailing wage is a requirement to get to that number. All right. So the 5 and 3, the building energy deduction got enhanced in two big ways. The biggest probably is in materiality way, $5 per square foot. In 2022, it was $1.88. And a lot of our clients took advantage of that because it's better than sticking yet. Now they've just jumped the shark and went all the way to $5 starting for buildings, place, and service in 2023. And they added on, you can do it every 3 years. If it was a lifetime on that building, you could take this energy deduction. And that was it. You know, that was good. This is better. And this is the one we saw in the middle column, the green one, section 48. And I had mentioned energy property earlier. This is what, these are the 10 energy properties that you're looking at that are eligible. You'll notice in the biogas, check out that one if you're in the agriculture industry. So if you're thinking of converting or capturing biomass, then this one is one you can vet out. Also notice the 10% domestic content bonus. So if you are using steel, iron, or other type of production from made in the US, you might qualify for that bonus. And that's on top of the 30%, not necessarily the 6. So you got to get to that prevailing wage 30%, then you can start playing with your bonuses. Okay, let's look at some examples. We got 1, 2, 3, 4, 5 examples we're going to go through. This one's healthcare example number 1. Thing to note here, it's a nonprofit. So the first time in legislative history, nonprofits can monetize these energy credits. And our healthcare clients are thrilled to be able to play in this space, in this game. So here's a behavioral health center that's opening up, or did just open up last week. South Dakota, about 100,000 square feet. They have some thermal energy, LED lighting, among other things in their construction. And they are eligible for and will be getting the clean energy investment credit. They'll also be doing a energy allocation credit, which falls under the 179D. They'll be getting both at the same time. So overall, $400,000. And they already did it. It's already been built. And they did it anyways. And now they get the $400,000 credit to boot. Let's look at one more healthcare example. This one's for-profit, senior living in Iowa, a lot of square footage, a good spend. They did some LED efficient HVAC, a touch of geothermal, and you can see how things start to stack up here. Right down to the utility sales tax exemption, which Iowa is a great state for that. And Chris will talk about that, and the employee retention credit, which Jim will talk about. You look at the incentive amounts, 400 for the energy credit, 3 million for the cost segregation and the energy deductions, no more sales tax on utilities. And if that wasn't enough, $2 million in employee retention credits. So did you know that cost segregation stacks well with almost any construction project? So while it's not energy related and it's been around for a very long time, it does allow you to get bonus depreciation on certain building components. And when it comes to stacking, think of it this way. You can have your cake and eat it too. And all our examples will have this incentive stack right in the middle. All right, entertainment. So this one, for-profit hotel and casino. This one's in Reno. Again, a lot of square footage. They did a renovation. LED lighting was part of the renovation. Some HVAC, efficient HVAC. They did throw on some solar. And so here, again, they get the investment credit. They get the deduction. They get the cost seg. The qualified improvement property, that's a holdover from the 2017 Tax Cut and Job Act. Another incentive that stacks well. And of course, the ERC for this industry group. And just look at the numbers here. Whenever you're renovating something, the numbers really start to add up. 400K in energy credit, 10 mil, plus another 18 mil of QIP and bonus and deductions. And of course, cherry on the top, the 4 million. Remember, particularly for this industry, the hotel, the casino, the entertainment, retail, the energy deductions available every 3 years. So as you're renovating different areas, hotel rooms, casino floor, restaurants, You can take another look, or every 3 years, you can take a look at the energy deduction and grab that. Let's look at one manufacturing, then one more example. Then we'll close it out and hand it off. So this is a food manufacturer in Utah. Again, a lot of square footage. This time doing an addition with the LED, the HVAC. They're introducing some heat pumps. We're seeing a lot of heat pumps actually in the retail space, the Home Depots of the world. The energy stack, a lot of the same stuff comes up over and over again. Utah plays very well with the utility sales tax exemption. Crystal will get into that. And so you see the amounts there kind of based off the spend. Something to note, did you know that construction can start in 21 and 22, not just for manufacturing, but for all industries we're talking about. And they can still qualify for these enhanced incentives if it's placed in service in 2023. And they could still qualify for a lot of these incentives just at a kind of a reduced amount if placed in service in 22. Okay. All right, last example. This one's for architects and engineers and contractors who are designing large square footage buildings. This one's a contractor client of ours who does HVAC. That's it. They do it for schools, hospitals, government buildings, primarily schools. In this case, emergency room addition and renovation, 80,000 square feet. They get the energy deduction. They get research and development. Jim will be talking more about that too, but for architects, engineers, and contractors, the R&D stacks very well with these things. They don't necessarily get the clean energy investment credit that goes straight to the hospital, the not-for-profit, but they used it for marketing their marketing materials to say, hey, because of the way we're designing what we're installing, you can now take advantage of this credit, and they helped them along that. $50,000 energy credit for the hospital, and that's the marketing, $400K to the architect, and then another $200K credit R&D to the architect. Did you know, this is especially for architects and designers, that the whole building method allows you to receive the 179D incentive, even if you're just doing one of those three things? So remember earlier I talked about building envelope, lighting, and HVAC. Well, in this case, they're just doing the HVAC, but because they're meeting certain thresholds with just the HVAC, they're getting the whole $5 deduction. It's called the whole building method. The energy incentive program works best when everyone comes together. It has to start at the leadership level when they're talking about sustainability planning, accounting and financing teams on the county planning. The facility engineers have to be in there right away so they could, during the master planning. Everyone comes together to configure a plan for your capital expenditure, your capital policy processes that satisfies your company's energy and tax saving goals year in and year out. What is the climate economy? This is where we start. This is where we're going to finish. Really, you're looking at it. This is a takeaway slide. Look at this one later in detail. Honestly, there's just been unprecedented government funding for sustainability and climate matters, ushering in this. At the nucleus of this bubble, you're going to see three things: CHIPS, that's that semiconductor legislation, Inflation Reduction Act, and then the Infrastructure Act. Those three things are all coming together to create this perfect storm. And what is the Energy Incentive Program? It's really cross-referencing your real estate and business portfolio with the climate economy, what you're seeing here. See where you are eligible to win. So with that, I'm going to hand it off to Crystal Schultz to talk about the utility sales tax exemption.
Thanks, Mark. So imagine what your business could do with more cash flow by paying less sales tax. That's what the utility sales tax exemption, or the USTE, is. It's a sales tax refund opportunity. And little disclaimer, as a former auditor, I used to poke holes in these opportunities. So I understand how to support them now, which I much better don't hold that against me. I'm on the good guy side now. So moving along. Oops. Who qualifies? This utility sales tax exemption is specific to manufacturing industry, to the agricultural industry, and then also to residential living facilities in certain states. There are more than 30 states that have this exemption available for the fuel and electricity used specific to the manufacturers in their production process. On the residential living facility side of things, there's probably about 15, 20 states that allow that. And what that means and what those industries are that would qualify there would be your assisted living, senior living facilities. It would be your, if you're in Kansas or Missouri, it would be a hotel even. Some of the actual living areas or the bedroom areas within the hotel. So there's different rules depending on where you are in the facility as far as the residential living facilities go, but there is a sales tax exemption available for the utilities, for the fuel and electricity, specific back to that residential area. And significant refund opportunities exist. One example I will give you is recent that I was working for with a cheese manufacturer, because I'm from Wisconsin. So of course we have cheese manufacturers here that I deal with. And their exemption, when I went in to help them and to start the process, they were not taking this exemption at all. And in reviewing, they were spending more than $60,000 a month on their electricity alone, paying 100% sales tax. At the end of the study and what we were able to support, they were eligible for a 95% exemption, which equates to, instead of paying $40,000 of sales tax a year, they're down to paying $2,000 of sales tax a year. That $38,000 is cash flow right back into their business. And we also were able to go back. Many states allow an opportunity to go back and recoup overpaid sales tax, roughly 3 to 4 years typically. And we were able to go back 4 years and recoup over $145,000 of overpaid sales tax. So this is cash, this is eligible exemptions, as long as we can support it. And the key is that support. Out on our iBailey website, there's this awesome map. And what you'll see, as I state here, the yellow states equal the refund opportunities. So those yellow states identify the 30 states that have the manufacturing exemption available for their utilities. And then within those states, it's interactive. So once you hover over a state, this is just an example, but once you're live on the website, you hover over a state, you'll see the box pop up. It will show you the refund period. That's our look back. So Tennessee has a 36-month look back period. And they'll also go through the eligible industries. So you'll see manufacturing and also that residential living here for Tennessee. Every state has that, that's yellow. You'll see those different opportunities in the industries that are applicable. Missouri is a unique one that I want to highlight. Once again, Missouri has a 10-year look back currently. So if you're a manufacturer there, residential living there, and also, as I mentioned, those hotels, there's a 10-year look back to go get that overpaid sales tax. Plus, you get to recognize it on the go forward. So what do we need to get started? Your business provides 1 month of utility invoices per location, your electric, your gas, your propane, and then we can review that invoice, see if there's an opportunity, propose estimated recovery amount, and then also discuss what those next steps look like. When should we consider? Well, if there's any uncertainty, if you're not sure if your business is currently taking advantage of this, probably should ask, especially if you're in one of those yellow states. If you take a look at your invoice and you see that you're being taxed at 100% and you're a manufacturer or you have residential living, again, we should probably take a look at it because this is a lucrative exemption and cash back into your business. If you look at your invoice and see you're maybe taking a 80–85% exemption, but you have no idea why, we should take a look because you are at risk for audit. And real life example, not on the refund side, but on the support side. I currently have a client that is under audit. They didn't have the support. They don't know where the number came from, but they've been taking advantage of that exemption throughout the years. And this could go way back. You know, somebody that's no longer with the company many times calculated the exemption at one point, but that backup paperwork is nowhere to be found. We have the job now to try to go support that number or come up with what the actual number should be. Under audit, it's a lot more scrutinized. So it's a little bit more of a struggle, but it's the same process. We still go through and we can get there. But we're under the microscope of those auditors. So again, it causes a little bit more of a struggle to get there. That current audit, they flat out denied what they had been exempting. It's $85,000 is what the dollar amount equated to that they're standing to owe on the backwards. And also they'll lose that exemption every month going forward. So it's important to have the support. Like I said, if you're currently under audit, we should definitely take a look and help out. Or many times I've come across different examples where the facility relocates and that exemption that they had just kind of rolls into the new facility, or they expand. That cheese factory example that I mentioned, they did an expansion, and that's how we ended up getting now down to the 95% exemption, or only 5% being taxed. So there's a lot of opportunity there, many different circumstances. But again, it just goes back to looking at that one utility bill to get the conversation started. And then once we realize there's an opportunity for you and we present that, the next steps would be we come out and we do a site visit. We compile all of the data. Everything pulling in electricity is computed, compiled, calculated based on your state's law and based on the exemption available. All of that support is yours at the end, a big, nice, fabulous booklet. And we go back and we file that refund claim with the state. Could be 3 to 4 years on average. Missouri, like I said, is a 10-year look back. And you also get to recognize that exemption immediately on your next utility bill. We would help you get the exemption certificate out there to the utility company, so you recognize those savings immediately as well. So not only the look back, but also on the look forward. So again, put money back into your business. And we'll move it over to the other Mark.
All right, thank you, Crystal. So I will talk to you about the ICDIS today, and I'll apologize in advance if I overwhelm you with information. It's an awesome topic, and it's kind of hard to truncate this down into a 10 to 15 minute conversation, but I will do my best. So several years ago, I was meeting with a company. They're in the agricultural industry. They grow crops here in the US, and upon meeting with them, I learned that they sold a significant portion of their crops into Canada. So once I heard that, I immediately asked them if they had thought about using an IC disc. I got a blank stare look back to me, and the question came back, what's an IC disc? So we had a fairly lengthy conversation about it. And once they learned about it, they were eager to put one in place. And as a result, they now get significant tax savings annually. So the great thing with the IC disc is that it's the, like Cousin Eddie says in Vacation, which I'll have to tie because of my last name, it's the gift that keeps on giving the whole year round. So what is an IC disc? The main thing is the abbreviation, it stands for Interest Charged Domestic International Sales Corporation, which is a lot to say. So commonly we just call it IC disc, or disc for short. More importantly though, it's a vehicle that allows you, the exporter of US made goods, to reduce your tax burden. And many industries can benefit from this. The manufacturing industry, as I mentioned, the agricultural industry, you can benefit in the mining industry, distributors of US made goods, as well as people who provide architectural and engineering services for construction projects that take place overseas. So why an IC disc? As I mentioned, the primary benefit with the IC disc is that it allows for permanent tax savings. And that savings that you realize is really going to depend on how your operating company is organized. So if you're a pass-through entity, you have to look through to the tax bracket of the ultimate owner. So let's just assume worst case scenario, the owner's in the highest tax bracket. What you would do is you would shift ordinary income into qualified dividend income. So for that highest tax bracket individual, you'd be saving 5.8%, going from a 29.6% effective rate on ordinary income down to 23.8% on capital gain income. C corporation is a little bit different. The effective tax savings you get with a C corporation is that you are making a distribution of corporate profits indirectly through the IC disc via the commission payment. And that allows you to avoid double taxation on the commission amount because you are able to deduct that at the corporate level. And that savings can be 16%. Another benefit, one that isn't commonly used but is available, is that you can actually defer income tax for one or a period of years with an IC disc. So if you're like me, it's easier to kind of see this with a visual. So to understand how this all works, in this example here, we have an operating company that is a pass-through entity. That pass-through entity sets up a subsidiary IC disc that is a separate corporation that elects IC disc status with the IRS. The operating company then pays a commission down to its IC disc subsidiary. It deducts that commission payment, realizing the ordinary tax benefit there. The IC disc is a tax exempt entity for federal tax purposes. State tax is another topic, and we could talk hours on that. So just for this purpose, federally, it's tax exempt. It doesn't pay tax on that commission income. It then distributes that back to the operating company as a qualified dividend. So at the operating company level, we've now shifted ordinary income to qualified dividend income, and the owner realizes the tax benefit as a result of that. And the good thing is that because we have this circular payment, the cash ultimately will stay inside the operating company, and with that reduced tax burden, they don't really have to make as much of a distribution out to the owner to cover their income tax payments, and they can reinvest that additional cash back in the company. So here we have a numbers example of kind of how we calculate that 5.8% tax savings in the pass-through entity example. There's a lot going on here, but just to point out, on the right side, we've added an IC disc. We'll assume a $10,000 commission payment. Bottom line is that the tax savings here is $580, which is 5.8% of the commission amount. All right, so as I mentioned earlier, C Corps, it's a little different scenario because C Corps don't get the benefit of a reduced capital gain tax rate like an individual does. So with a C Corp, you would want to set this up so that the IC disc corporation is directly owned by the shareholders of the C Corp. And as you can see here, ultimately what's going on is you're making a distribution from the corporation indirectly through the IC disc. And because we're deducting that commission payment at the C Corp level, the C Corp is getting the tax benefit, and we are eliminating the double taxation on the commission payment. The downside, though, to this is that the cash has now come outside the corporation. It's in the hands of the shareholder. And so if you would want that cash to be reinvested within the corporation, the shareholder would need to loan it or recontribute it back to the operating company. And a numbers example for the benefit with a corporation operating company, again, we'll assume a $10,000 commission in this example, bottom line is our tax is reduced by $1,600 if you factor in both the corporate tax and the individual's dividend tax. And so 1,600 divided by 10,000 commission, that's where we get the 16% savings. All right, so we talked about what the IC disc is and who benefits from it, but the question really comes down to is how do we calculate that commission amount? Because the commission amount is what drives our tax savings. So the commission is calculated based on the sales of what we call qualified export property. And qualified export property comes down to 3 tests. As long as all 3 tests are met, it's considered qualified export property. And then that sale can be, the commission can be calculated and you can realize your tax savings. So the first of these tests is called the manufacturing test. The property being exported has to be produced in the US. So for industries such as agricultural and mining, it's pretty straightforward because crops are grown on US soil or minerals are being extracted from US soil. Manufacturing can be a little bit different though, because in the manufacturing industry, you can convert raw materials to a finished good within the US. That's a clear-cut example that would be manufactured in the US. But you can also reach manufacturing by improving upon an existing product. And this is what we call value added to property. So for example, let's say that you buy a shirt, the shirt was made outside the US, you buy it for $5. Then at your facility in the US, you have a printing facility, you have graphics to this shirt. And then let's say you have a $5 cost of labor to add the graphics to the shirt. So now we have a total cost of $10 that has gone into this shirt. And because we have achieved this 20% conversion cost within the US, our shirt with the graphics would now meet the manufacturing test. The second test is that property has to be sold for ultimate use outside the US. And this is the test that can be somewhat tricky to meet. The most common way to meet this, and probably the easiest way, is that you have a direct sale for export. So you are selling directly to a foreign customer and shipping outside the US. But you could also meet this test with an indirect export. So for example, you are a manufacturer and you sell your property to a distributor in the US. That distributor then turns around and sells the same good for export, so to a foreign customer, and they ship it overseas. So in this case, the manufacturer's sale to the distributor would qualify for the ICDIS benefit because that property is ultimately being exported by the distributor. In addition, though, the distributor's direct export would also qualify. And this is where distributors really can get a benefit from the IC disc, because you don't necessarily have to be the manufacturer or the grower or the producer of the good that's being exported. That property just has to meet the manufacturing test in addition to the destination test. So if a distributor is buying goods that were made in the US and then selling it for direct export, that distributor can potentially benefit from an IC disc, and they should look into whether one would work for them. Couple items though that can trip people up on the destination test. Property can't be used or further manufactured by the purchaser prior to it being exported. And secondly, there is a proof of compliance. So the seller would have to prove that the property was ultimately exported. And this can be sometimes tricky if the seller does not have access to the export documentation. The last test is the fair market value test, which states that no more than 50% of the fair market value of export property can be attributed to imported materials. To make this easier to understand, if we go back to the earlier example, we were talking about shirts. We bought that shirt that was made outside the US for $5. So we have now $5 of imported material value. And let's say after we've added our printing to that shirt, we then turn around and sell it for $20 to our customer for export. So we have a $5 imported value, we have a $20 sales value. So 25% of our sales value was attributed to imported materials. And because that's less than 50%, we would meet the fair market value test. All right, so now that we know what qualified export property is, we've gone through the 3 tests, we've met the 3 tests, how do we actually calculate the commission amount? Ultimately, what you need to do is you need to calculate a net income on the export property. So you take your revenue on the export property, subtract out your cost of goods sold, and then subtract out an allocation of SG&A costs. And that gives you net income. The commission is then the greater of either 50% of that net income amount or 4% of the gross revenue amount. And there are some limitations to what that maximum amount would be, can be, based on where your net income ultimately falls out, but it's generally the greater of the 50% net or 4% gross. So finally, I wanted to give some examples of the calculation. I'm not really going to go into detail on this, but just wanted you to take away here that the default method for calculating the commission is on a per transaction basis, which can be beneficial because by breaking the transactions out and calculating it separately, it oftentimes leads to a higher commission than if you were to calculate it on all of your export sales group together. And in this example, you'll see that we were able to increase the commission by $80 by having everything separated out. And really what this does is allows you to maximize not only the commission, but therefore your tax savings and allows the gift to keep on giving. So if you are exporting US made goods, it's really a good idea to look into an IC disc and see if you can generate some tax savings with one. I will hand it over to Jim.
Awesome. Thank you, Mark. I appreciate it. Looking forward to speaking to you all today. I'm going to cover some incentives, new and old, that are cash generators that should be considered in your credit stack. So these are going to include incentives in the Inflation Reduction Act, and then research and development tax credit, as well as the employee retention credit. So recent law has given us more to consider to offset tax liability, and there can be some fine print that you need to be aware of to maximize these credits. And we certainly can't get into all the minutia today, but I wanted to share how these incentives can benefit your organization. The R&D tax credit and the production tax credit can be annuities, whereas the investment tax credit and the employee retention credit are one-time benefits. So we'll start with our most recent law change, which is the Inflation Reduction Act, and talk about some of these incentives, right? So as Mark Rogers mentioned earlier, there's an increased focus on environmental impact and reducing the carbon footprint for organizations. And the current administration really reinvigorated some of these incentives with the Inflation Reduction Act to offer some return on investment in clean energy. So as part of the IRA, we have production tax credits and investment tax credits. In general, your production tax credit is going to be generated based on production metrics. So it's going to be cents on a kilowatt hour, for example, versus your investment tax credit is going to be a one-time benefit, right? So this is going to be earned based on the cost basis of the clean technology deployed. Depending on the type of clean energy installed, wind, solar, biogas, thermal, or geothermal, et cetera, right? You can either take a PTC or an ITC, but you can't take both, right? And you know, the credits certainly vary, in terms of the benefit. And so it's really kind of important to understand, hey, what might we qualify for, and how do I really maximize that benefit if I'm going to invest in clean technology, right? So in terms of benefit, as Mark mentioned, the investment tax credit rate, that can vary from 6% or up to 30%, or really even 40% in some cases if prevailing wage, apprenticeship, domestic production is met. For PTCs, again, that credit's going to vary. Again, it's based on a kilowatt hour produced or some unit of production, right? But those credits can actually add up because you're taking them as an annuity year over year, right? So it is important to consider, gosh, what's best for my organization? I list out some of the credits in play, or some of the more popular credits that are in play. You've probably heard a lot about carbon capture and sequestration recently. That benefit is significant. I know they all have similar names, right? And a lot of these mirror each other. So there's an investment tax credit or a production tax credit. Again, we would help you determine what's really the best benefit for you. In terms of looking at these, right? Well, what's the time frame? For them, in most cases, we're really looking at property placed in service after 2021. So really, now is the time to start looking at your capital expenditure planning, that roadmap, saying, okay, do we have any green technologies or clean technologies that we're deploying where we need to consider this? Or should we be considering it? Because maybe we need, combined heat, heat exchange, right? So, gosh, is that going to pay off versus putting in something more traditional, right? So again, it's important to start looking at this now. I will mention that there is a direct pay option for exempt organizations. So our tax exempt nonprofits, they previously haven't been able to play in this space, but now they have the opportunity to. So again, a lot of people can take advantage of ITC and PTC. Now, we certainly don't have time to talk about all of the credits out there that are included as part of the Inflation Reduction Act. This slide is more of something you can review in your free time, right? But you're saying, gosh, Jim, well, I'm thinking about some weird hydrogen thing, or nuclear power or whatever, right? There may be a credit for that, right? So again, this is something to review in your free time to say, gosh, you know what, maybe there's some sort of alternative fuel out there that we're considering, and I need to learn more about it, right? All right. So you're probably saying, gosh, Jim, it sounds like there's opportunities to take either a production tax credit or an investment tax credit. Gosh, one-time benefit could be significant, could really help. Maybe I need the benefit over time, right? The reality is there's no easy answer to any of these. You do have to model out the benefits. So there's some fun spreadsheet work here, right? But at the end of the day, and I'll tease our eco process, right? Explore, create, and operate. Our job is to help walk you through that process. As I mentioned earlier, there are a lot of rules, right? I know Mark mentioned prevailing wage, apprenticeship, domestic production, right? Or domestic content. Those are all things that impact how significant a credit could be for you, and whether it makes sense to go forward based on that return on investment. So as part of our eco process, we understand the rules and we help you so you don't miss out on an opportunity, because nobody wants to get a 6% credit on clean technology when they didn't pay a high enough wage, that prevailing wage, to get a 30% credit. Because gosh, that additional wage cost would have been well worth it in terms of that return. And again, part of that eco process is just understanding all the incentives that are available and helping you stack those. So Mark mentions the built environment, right? How do we layer in 179D and 45L and all the other things you may qualify for, in addition to what's in the Inflation Reduction Act. So let's talk about some industry winners for Inflation Reduction Act. It's really, the target of this webinar, right? So manufacturing, hotels, casinos, warehouses, office buildings, parking garages, hospitals. Again, a lot of winners here where they, you may be investing in clean technologies and can get a return on that investment. All right. A second area to consider is an older incentive. It's been around since the 1980s. It's an annuity for those that continue to perform or invest in R&D activities. And also, depending on the clean technology deployed and how it was developed for your organization or your operation, we may be even able to take an R&D tax credit on one of these green or clean technologies that you employ in your organization, right? So now you're either getting a production tax credit or an investment tax credit, and there's a benefit to the R&D tax credit for how it was developed. So again, this it really goes to credit stacking. How do we maximize our incentives, right? So just in general, the R&D tax credit, as I mentioned, been around since the 80s, designed to promote innovation, ask companies to push the envelope, entice companies to stay and invest in R&D in the US or a given state, right? There's a lot of positive state incentives out there. What I always tell people, or my biggest challenge with R&D, is the tax definition is very broad. I was on the phone with our Omaha office today, and they were telling me, yeah, this guy doesn't think he does R&D, but yet he has 7 engineers, Jim. They're just supporting, right? The biggest challenge we have is to really walk them through, hey, what is the tax definition of R&D? New or improved products, processes, software, techniques, formulas, inventions, all this can qualify for the credit. So again, I look at those processes, right? If you're investing in clean technology, maybe you're buying something off the shelf, but maybe there's a lot of design work in how it's applied in your operation. And that's where R&D comes in. A couple of just credit examples, right? Because at the end of the day, it really helps to just understand, hey, what's the benefit to me, right? So in our first example, a dealership. And it really goes to the example of every company is a technology company nowadays. I can't believe how many companies I talk to, and it's like, yeah, Jim, we had to go develop software for something, right? In this case, the dealership developed software for digital documents, inventory tracking, test drive process, and improved reporting, right? Now, granted, they're not doing a ton of R&D year over year, but in this case, they got a combined federal and state credit of $60,000. On the flip side, I have a food manufacturer, and they're constantly developing new products, new processes, and basically they're getting over $1 million a year in combined federal and state credits. So it's a really nice annuity for them, right? So the final credit in my discussion that can really be a part of anyone's stack is the employee retention credit. This came out as part of the CARES Act in 2020. It's been extended and expanded twice. Originally, hey, if we took PPP, we couldn't take ERC. That's since been changed. You can double dip. In terms of taking both incentives, you can't use the same wages for both. But as a quick reminder, if you've been living under a rock, because I know you all have 500 emails from providers about the ERC, 2020 is up to a $5,000 credit per employee, 21 up to a $7,000 credit per employee per quarter. So if you can do some math at home without a 10 key like me, it's up to $26,000 in benefit of credit per employee. It's fully refundable. It's claimed on 941. So gosh, it could be a significant number, right? I do want to point out that the ERC was repealed for 2021 Q4. I still get that question a lot, but it is not on the books. It was repealed as part of the Infrastructure Act. All right. In terms of being an eligible employer and qualifying for the ERC, so you really need a significant decline in gross receipts. Those rules are different for 2020 versus 2021. You need a really significant decrease in 2020. That 50% or greater than 50% hurdle is a huge challenge. We have significantly more clients qualify under that in 2021 for the credit. The gross receipts definition is very inclusive. You can also qualify due to a suspension of operations due to a government order. We have more orders in 2020, so that's your better chance to qualify. There are some additional tests. It's not just that a government order is in place. If your numbers and metrics are up significantly, you still may not qualify for ERC. We have to show that there was more than a nominal impact and more than a nominal effect. So that testing is done. That said, ERC can be wildly lucrative, right? So we have a senior living campus, and I think this is in Mark's example earlier, right? There are a lot of government orders, and in this case, there were 300 employees. They qualified for via a government order. They met the more than nominal testing in Q1 and Q2 of 2021, and their combined credit was really over $2 million. The other thing that we have, or the other industry that we've seen a lot of qualification in, are casinos. In this case, they had 140 employees. Again, we had a suspension of operations. Limited people were allowed in the casino, right? So we got them over $500,000 in credit in Q1 of 21, another $200,000 in Q2. You're probably saying, gosh, Jim, why was Q2 lower? Well, they had PPP too, and we can't take the same wages for both. So there was certainly an impact there, but I don't think they're complaining too much. All right. Wanted to talk or revisit our ECO process, right? Because you're probably saying, gosh, Jim, this sounds great. This is a lot to absorb, right? You've got Mark talking some international thing that sounds pretty cool. Crystal's talking about these sales tax exemptions. Mark's talking about all kinds of credits in the built environment and additional deductions. You're saying, how do I make sense of it, right? So we have our ECO process, aptly named. Thank you, Mark Rogers. But really, we break it down into 3 phases, right? Exploration is really understanding, hey, what's your master plan? What could you qualify for, right? These are discovery calls, really understanding what you want to do, what you may have in process, and, gosh, can we help, right? What are the implications? You may be saying, gosh, well, we weren't really thinking about going internationally, and then we got into Italy almost by accident, and now we don't know the ramifications, right? We can absolutely help. So that's the exploration phase, right? Creation is really putting in the plan, hey, gosh, yep, you're going to qualify for R&D. You're going to qualify for a production tax credit, or it's more optimal to take the ITC over the PTC. Hey, here's what you need to do on prevailing wage. This is what we can do to accelerate depreciation on the assets you already have in place. Oh, by the way, let's add ERC because you didn't think you qualified. Turns out you do. So that's the creation phase. And then operation, hey, that we're executing on everything, right? We're getting your tax credits, your deductions, amending returns. Maybe we're helping you implement carbon accounting software, right? Maybe we need to help with that ESG disclosure. There are a lot of things that we can do to help make your lives easier. And so that's our ECO process. Now you're probably saying, gosh, Jim, that sounds wonderful. How do I get started, right? Well, we'd love to do a discovery call with you. We have CPAs, professional engineers, HERS raters, we have lawyers, we have people on Capitol Hill. We have all the people you need to help you. In fact, I have, not an engineer, but a geologist on my team. It boggles my mind that, here I am at a public accounting firm and I have a geologist, but carbon capture is real, and we want to help our clients take advantage of it. So again, don't hesitate to reach out. We are more than happy to help you. And thank you for your time today.
Well, I guess we do have one question here. Would a commercial real estate company that deals with commercial office space, restaurants, multifamily units have a change to qualify? I think it meant have a chance to qualify.
So good question. I guess yes. The answer is yes, right? The question is for what incentives, right? And they could qualify for for several, right? I look at this and I say multifamily units, right? Mark, that screams 45L maybe, maybe some 175D retail space, right? 179D. You never know about ERC.
Yeah, the question came up while you were talking on ERC, so I wasn't sure if that was on ERC or anything else, but certainly if you're looking to collect your stack, almost everything on the energy side and the building incentives absolutely can apply retroactively and proactively. On the ERC, I think that would take a little bit more digging, I would think, right, Jim?
Yeah, absolutely. We would need to look at gross receipts most likely. I look at retail space, right? 2020, we certainly had some government orders that limited access. So there's a couple potential ways to qualify.